Our next guest suggests this year's popular risk-free trades have a shelf life. Paul McCulley is PIMCO's former chief economist. He now teaches at Georgetown's McDonough School of Business. Paul, great to have you with us. Why shelf? You think that these rates only last for another year or so?
Yes, that's what the yield curve is telling us, as well as the fact that disinflation is clearly in train. It's not as fast as some people would like, but it's clearly in train. And the starting point is a restrictive Fed policy. When you have restrictive Fed policy and also have disinflation manifestly in train, that's not the stuff of a hard landing. That's the stuff of a soft landing. And I think that's basically what the equity market has been romancing for the first 6 months of this year.
The equity markets seem to want to believe what they want to believe, Paul, and I guess that's always the case. But I mean, I'm wondering, from your standpoint, has your view in terms of how high the Fed goes and for how long, has it changed based on the most recent jobs data as well as today's CPI?
No, it hasn't. I've been anticipating that the Fed would go to plus or minus 5%. And effectively, the marketplace is now pricing that, having reversed some of the hopes for a quicker pivot that we saw a few weeks ago. So in general, the script is unfolding that the Fed is going to wait for beyond a reasonable doubt evidence that inflation is down for the count. Whereas the marketplace is going on the preponderance of evidence thesis. So it's an easier burden for the market than the Fed. And I think the market is saying the Fed's going to be successful. It doesn't mean that it's not too giddy right now in a very short-term basis. But fundamentally, I think the Fed and the marketplace, broadly speaking, are in alignment these days.
Well, it's Karen. So this shelf life for the 6-month Treasury bill, where do you think it's going, and how long does one have to buy it at this yield?
The 6-month bill is the same thing as the Fed funds rate. They are mechanically linked. So when you ask how long is... They haven't been,
actually, somewhat, but continue. I'm sorry.
I mean, they have a little bit of slippage in them, but broadly speaking, they are one and the same. So when you ask how long is the 5% bill rate going to be, it's how long is the 5% Fed funds rate going to be? It's the pivot question. And I think the Fed will rhetorically, and I stress rhetorically, pivot sometime this summer, and then we'll actually see the first cut by the end of the year. So essentially the half-life for getting this 5% 6-month bill, I think, is probably the next 6 months.
It's only February, and we're talking about August already, Paul, because you're referring to Jackson Hole. And I thought that was interesting when you said that you think that logically the Fed will probably start talking about a pivot or planting that seed at Jackson Hole. That makes a lot of sense. And you're actually anticipating a cut by the end of the year. So you do have, even though Jerome Powell has said, I don't see that happening. He said that at his press conference. So you're saying that you don't believe the Fed either.
No, I believe that Chair Powell has to say that. Remember, he wants his rhetoric to err on the side of restraint. He hasn't foreclosed that possibility. He's just simply said, I don't see it now, and that's natural given the seat that he's sitting in. So I don't have a big disagreement with Chair Powell. I think he's doing a really wonderful job from the standpoint of leaning against excessive exuberance, at the same time saying this disinflation is for real. It hasn't gotten as far as we want, but it's for real. And most important, we're in restrictive neighborhood. We may go to an even more restrictive house in that neighborhood, but we're in the restrictive neighborhood. So the next big strategic call is when they pull back from the restrictive neighborhood on disinflation success. And I think that's what the equity market is romancing now.
You used excessive and not irrational. Was that on purpose?
Yes, it was.
Okay. Just wanted to clarify. Paul, great to see you. Thank you.
Thank
you.
Paul
McCulley.
Well, Professor McCulley was the chief economist at UBS when Greenspan uttered the terms irrational exuberance, and I was on the trading floor that day. And the world is so different, because if you think about a Fed that's gone out of their way to communicate to this market, this was not what the Fed was doing back then. But Paul's been right. He was on our show a month and a half ago or a month ago, and he's been leaning bullish, and he's been leaning on this concept of that there have been this moment, and maybe we had that moment where the Fed kind of peaked. I would just go and say that short-term and medium term is how I think about this market. And I think we've got a case where 30% of the fund managers out there feel like they are not exposed enough to cyclicality if this market turns, that 75% of them actually believe that we're now not in a recession. And whereas it was 75% back in November that said we were going into recession. So I just think we're at a place here where I follow the market clues, which are the cash levels, which are the positioning. And it seems to me like the pain trade's higher, even though the math doesn't make sense in terms of where the S&P and where earnings are.